All right, I'm going to go ahead and call the meeting to order. We'll start with roll call. John Vischer, member.
David Rader, member.
Matt Barker, member.
Pat Keough, member. Harvey Lewis, member.
Matt Buxton, guest.
Rick Williams, staff.
William Johnston, staff.
Brendan Vavrica, Inco Consulting.
All right, great. We have an agenda before us. I'd solicit a motion to accept adoption.
I move to adopt the agenda.
Second. All in favor, please say aye.
Aye.
All right, we have an agenda. We have the minutes from the last meeting.
Move the approval of the minutes.
Do I have a second? All right, very efficient, gentlemen. Approval of minutes has been made.
Move to adjourn. Oh, no.
All right, friends from Loomis Sales, you guys, you're up. So here.
Great. Well,
All right.
thank you all. I think we are waiting for my colleague to join via video, Jonathan Kimbrough.
Yeah, we're 2 minutes early, so that's fine.
Yeah, he's aware. He is. I can start while we're waiting for him to join. Full disclosure, he is in Hawaii on vacation with the family, so it's a little bit
Oh, wow.
middle of the night there, but he wanted to make sure he joined the call
Okay.
today with you all. So thank you all for the time today, and thank you for the relationship with Loomis Sales. My name is Matthew Buxton. We've met in the past over video, but it's great to be here in person. I'm your relationship manager at Loomis. I've been with the firm since 2019. What we thought we'd do today is give you a brief update on the firm, and then talk about the portfolio and really focus on positioning and outlook, and kind of where we go from here, and how we see markets, and then how's that going to impact our portfolio.
There's your partner.
Yes. Yep. Jonathan, can you hear us?
Yes, good morning, Matt.
Thank you. So if you just go, everyone has presentation materials, I believe. So if you go to slide 3 and just touch on the firm briefly, about $278 billion in assets, probably a little higher now given some of the market impact in October. We continue to see client activity across the firm, probably in slight net outflow at the firm level, and it's really driven by 2 fronts. Number one, the beginning of the year we had some large withdrawals as people were rebalancing when fixed and equity went down. So from our fixed book, we did see some large withdrawals as part of that. Some of those assets are starting to come back. But we have seen that, and then our large cap growth, which I'm sure you all are aware, very difficult asset class this year. We have seen a little bit of net outflow there, but overall the firm remains steady. I think I noted last year, but we did add a private credit team based in Minneapolis. We lifted them on a securing asset management. That's something we'll bring to the market a little bit judiciously over the next few years, probably leaning towards the insurance business in the near term, but it does speak to our strong partnership with Natixis, our owner, that we're able to add that type of capability and lift that team out to add to our investment lineup. So we're pretty excited about that. You'll hear more of that over the coming years. I did want to note, I know it's in the news, I'm not sure if you saw it, Loomis is doing a voluntary separation package. And really what that is for, about 100 employees are eligible at the firm. No portfolio managers or board members are eligible. And really it's twofold. Number one, it's really trying to open up opportunities for some of our younger people who are coming in, more leadership roles. Loomis is a very tenured firm in particular. People who have worked at Loomis for quite a long time, and it's also to reward folks as they kind of get to that point in their career where they're going to be transitioning. There's 3 criteria to meet it, so it's a very small subset of folks, and it's completely voluntary. We don't have any plans to have layoff or anything like that, but it is in the news, so I did want to highlight that. Your investment team will not be impacted. No investment team at the firm will be impacted by this. Before I turn it over to Jonathan, I'll touch just briefly, if we move ahead, what's the performance slide here? Sorry. If you go to slide 18, you can see the performance year to date. About flat net relative to the benchmark. Really a brutal year in fixed income, brutal year in markets. The portfolio has held in there against the market, and Jonathan will touch on a few of the drivers of those. But you can see is the 1, 3, and 5 year, solid outperformance net of fee relative to your benchmark, and since inception, around 45 basis points net of fee. So relative strong outperformance. Obviously a very difficult 2022, and Jonathan will touch on that. Before I turn it over to Jonathan, does anyone have any questions for me about the firm?
What's private credit? Is that you originating?
This team is primarily a private placement team, so they'll work in a syndicate type structure. So they're not really, I wouldn't call them originators of private investment, where they're going out and sourcing a deal with a corporation and putting a deal together and then syndicate. They're more in the syndicate. They're not the kind of lead.
So they're buying them from somebody?
We're working with a group of investors to structure a deal. So they focus definitely on the insurance side. So, kind of lower top end IRR, but definitely more sleep at night, higher up the cap structure, different, more higher quality names. Jonathan?
Okay, great. Thanks, Matt. Good morning, everyone. I'm Jonathan Kimbrough. I'm the investment director for the Discipline Alpha team. Thank you for the opportunity to give an update this morning, and thank you for your investment in the core Discipline Alpha strategy. My goal was to provide you with a quick update on our team, our business, your performance, and a bit about our outlook for the coming quarters and the coming year. As a reminder, our team is located in Orinda, California. While Loomis headquarters is in Boston, our team's always been stationed in the Bay Area. And the senior team of investment professionals has been stable since inception with no turnover. However, we did lose 2 of our junior staff in the quarter. Darlene Lee was a junior trader, and Patrick Scardino was a trading assistant, and both of them left to pursue other opportunities outside the firm. What we've found, to Matt's point, is that the bid for young talent, especially with a year or 2 of trading experience, is extremely competitive right now. Fortunately, Gabriela Servan-Sinde-Haas was an investment associate on our team. She's been promoted, and she will step into the junior trading role on the securitized desk, so we'll have no lapse in coverage there. We do have 1 open requisition, and we'll be looking to hire someone for that trading assistant seat by the first quarter if we're lucky. Our total assets were at $16 billion as of the end of the third quarter, and you can see our asset mix on page, sorry, I just lost the page number there. It was page 7. I think like many asset managers, our assets are down in this environment due to market depreciation, but we're fortunate to be experiencing net inflows in our platform. We have net inflows of $300 million year to date, and most of that is going into the core Discipline Alpha strategy in which you're invested. That's our largest strategy with more than $9.7 billion, and it's our most diversified by client type. And we have a couple of commingled vehicles there, the CIT and the NHIT, in which you are invested. We've seen broad interest across all of our products, but the core strategy has seen the most interest, and we've actually seen outflows from our corporate and long-corporate strategies for pension payments and pension risk transfers. So if no questions there, I'll turn to page 19, where I'd like to just give a brief reminder on the strategy and our style of investing. So this is the quarterly excess return history for the core Discipline Alpha composite. And what I'd like to note is that the strategy has never underperformed in any single year. And there's only been 4 quarters since inception where we've had a underperformance relative to the benchmark. This is a strategy that seeks many small contributions over time from continuous relative value and bottom-up security selection. We think that's our strength by using Loomis credit research, and so therefore we've structured our investment process to play to our strengths by limiting the top-down risks. We run the portfolio duration neutral, meaning it is matching the benchmark duration at all times within a very tight tolerance. And even during the trading day, if we buy or sell a corporate bond, we're immediately crossing that with a duration matched treasury at the same time so that no interest rate effect is getting into the performance. In addition, we try to control the top-down risks of sector exposure, industry, and issuer exposure. And what this results in is a portfolio that looks and feels similar to the benchmark. It performs like the benchmark in times of crisis, but it has a consistent stream of excess return in any given quarter. What I would note on this chart is that in times of higher volatility is when our strategy tends to do better. We find more opportunities for security selection when security dispersion is higher. And you can see that play out in this chart with some higher returns around 2011-12, the European banking crisis. There's some higher returns in 2016 during the energy market dislocation in the United States. And our greatest quarter of excess return was during the COVID pandemic lockdown in the first quarter of 2020, where we had very high returns following a liquidity-driven sell-off. So with that in mind, I was going to turn to performance for your individual account, which you can see on page 24. These are the net returns for your specific strategy, and in the quarter we earned 23 basis points above the benchmark, and for the year-to-date period we are positive, just barely at plus 2 basis points on a net of fee basis. I looked at our investment results, which it ranks our performance relative to peers, and for the third quarter we were right at median, right at 50, and for the year-to-date we were right at median at 51. And we'd say that's typical of this strategy. We're never going to be your top performer or your bottom performer in any given quarter. We tend to be around the median, but over the long term, we will gravitate to the top quartile, and that has proven out in investment numbers through 9/30. We're in the 25th percentile of returns since inception. The attribution for your strategy can be seen on the following page 25. And I'll just note here that these numbers are slightly different than your returns. Your account modestly outperformed our trust due to the timing of your redemption. I believe you made a redemption on September 28th, and the market continued to go wider on the 29th and the 30th, so the timing of that redemption helped you avoid a couple more days of widening market, and you will see your performance is slightly better than the numbers you see here.
All right, William.
For
Good job, William. That was luck, not skill.
well, luck still counts. For the third quarter, I mentioned security selection is supposed to be the primary driver, and you do see that coming through in the third quarter with 21 basis points all coming from security selection. The majority of that is in credit and some in ABS. In the year-to-date period, you do still see positive selection effect of plus 17, but the major detractor there is our sector allocation of negative 14. And that's because of our sector overweights in a period of widening spreads. We were overweight really all four risk sectors: MBS, credit, CMBS, and ABS, and all of those widened throughout this period. I think with the exception of ABS had some modest flat performance through this period. We can touch on a couple of individual contributors and detractors for the credit portion, which you can see below. And generally, credit has been a strong contributor in security selection this year, but our overweight did hurt as the markets went wider. July was very strong for credit, and then September was an equally worse month for credit and a lot of other asset classes post the Jackson Hole conference. There really got some determined speak from the Federal Reserve that they were going to combat inflation and really start to hike interest rates, and that led to a risk-off rally to end the third quarter that really was detrimental to a variety of asset classes, including equities. In our portfolio, we're able to outperform, and a couple names there are upgraded candidates, rising stars. First is Occidental Petroleum, or Oxy. This name outperformed during the quarter after Warren Buffett planned to increase his equity stake. And they also had a very solid quarter of earnings potential, and the name outperformed, and it actually tightened all the way through to our sell target. Even though we were expecting an additional investment grade upgrade for Occidental, we went ahead and sold because the market was fully pricing that in at that time. Another upgrade candidate in the energy space was First Energy, and this is a name that did receive an investment grade upgrade during the quarter, and also resolved the hangover from a bribery scandal with Ohio, and that name continues to see strong outperformance. AES Corp is one of our largest overweights. This has been in the portfolio for a while. It's a diversified energy company, one of the leaders in alternative energies, particularly battery storage, and we believe they're a prime beneficiary of an Inflation Reduction Act. Any subsidies that are sent from the federal government, they're well positioned to take advantage of that and to continue to invest in R&D across battery technology and different sides of renewable energy. On the detraction side, CSX Corp was our top detractor for the quarter. This is a name that is it's a railroad, and the name really underperformed due to recessionary concerns and fears that rail volume would decrease in a recessionary environment. Dell Bank is another one that Dell had benefited from pandemic lockdown, lots of people working at home, they were buying computers. So early in the year, that name had done well. But as the year went on, a lot of that pandemic buying of home computer equipment softened. Dell is a triple B name. It tends to be right on the cusp of high yield. And due to recessionary volumes, we decided to sell that name. It underperformed, and we decided to swap into a higher quality name like Intel, which was one of the top contributors for the quarter. In terms of our sector exposure, which you can see on page 27, the team is fairly cautious at this point. Our credit target is modestly overweight. Here you'll see that we were 5 pi overweight in quarter. At the end of the quarter, we've just since raised that target to 10. And this allows us to take advantage of some opportunities in the new issue market without being too overweight in the credit space. Just yesterday, there were at least a dozen new deals that came out, as we've had a backlog of new issue supply this year. We participated in a lot of them. Several of them had significant new issue concession of 25 to 20 basis points, which is great. A couple of the deals did not. For example, the new Oracle deal yesterday actually priced with negative concession. So having a plus 10 target in credit allows us to take advantage of this new issue market and really sift through those deals to pick the ones we want and still have ample risk target room to add. ABS is a sector where we're overweight, and in fact, we're at the max overweight at this point. Much of what we own in the ABS space is high quality, short dated paper. It tends to be senior, and given the relative value to corporates, we think ABS is extremely cheap at this point. One of the metrics we look at consistently is the difference between John Deere corporate bonds and the difference between a John Deere equipment trust in the ABS market. It's a similar risk, it's a similar company, and you can have a similar type of bond structure, but what we found in the ABS markets is a 3-year ABS bond is offering almost 35 to 40 more basis points than a considerable corporate bond with the same duration. So the ABS overweight is something that we have taken to the max level, and we do feel that that's a very attractive asset class right now.
Jonathan, Jonathan, I got a question for you. On the new issue market, are you seeing a little bit tighter covenants in some of these new issues? I mean, previously some of the covenants got pretty light, but I'm just kind of curious how the structure of these deals, have they changed much?
In the corporate bond market, I have not seen much difference in covenant structure. No, I haven't. Maybe in middle market or bank loans, I've heard more about stronger covenants, but I haven't seen many changes in the corporate market.
Okay, thank you.
Sure.
We've been seeing a lot of, in the bank loan market, you're starting to see some, LBO activity and some looser covenants in that space. The credit quality of the bank loan market used to be double B, it's now B, and the high yield market is double B. So they've kind of switched positions, and that's a unique situation historically.
Do you make any accounting for potential defaults? I mean, do you make any allowance for that role?
Jonathan, we have a default estimate in our risk report, in our risk profile, correct?
Default estimate?
Yeah, I know Loomis has models that will tell you over like the next 12 months, we expect this amount of, our high yield model going into the year the model actually showed 0 default risk. We actually didn't believe that, so we moved it up. Right now it's around 2%, I think, in the high yield space. There's talk it could go to 4, but that's, it depends. This is one of the unique times when usually in a recession or when high yield spreads widen, it's usually led by energy. Energy are the names that typically do the worst going into a recession. They're actually doing the best. And so if you go back to 2016, 2015, even 2018, 19, you saw a lot of default risk in the energy market, less so in other parts of the high yield market. This time they're in better position than they have been in, generation, some of them.
Well, another, just John Bishop, another just question, is it's more maybe philosophical, but in terms of the liquidity risks, you know, with a lot of the, you know, there's, well, a lot of the prop desks, you know, there's not as much bid as there used to be if we ever have a liquidity crisis. I'm just curious, are you seeing liquidity stressing some? And then if it's short-term liquidity stress, I don't think we're overly worried about. What I'm more concerned about, and weighing that against the liquidity issue, which would be more short-run impact, the credit quality deterioration, are you seeing, what are you seeing broadly in the various credit markets?
In our side, in investment grade credit, we're not seeing that much of a drop in liquidity.
Okay.
For our portfolio, we've always had a bias for upping quality and liquid holdings. So in the event of a liquidity-driven sell-off, that's when we outperform, and we aim to be a provider of liquidity in those environments. We still think we have daily liquidity on everything we own in the portfolio across all of our strategies. So for us, we're not seeing any real impact of it.
Okay. And then credit quality in both your portfolio and the broader market, are you seeing that? You know, you mentioned the bank loan market, which, you know, is sort of fallen on, you know, deteriorated some. I'm just kind of curious in general, are you starting to see deterioration or concerns of a growing deterioration from your viewpoint?
For my market, investment grade, no, not yet.
Okay.
In fact, we're still coming through a wave of upgrade candidates. You know, I mentioned a couple, but over the past year, we've seen more names upgraded than downgraded in the space that we play in. That could change next year, I said, as this plays out. But no, we haven't seen any deterioration in credit quality in our center.
You know, in the high yield space, it still looks pretty good. Companies, you know, corporate balance sheets are better. Coming into this, they're better than they have been in a very long time. Corporations have done a nice job of, there's no maturity wall out there like there was coming out of the GFC, where you had that kind of 2012, 2013 massive refi wall. That's not out there right now. It's not really an issue. Like I said, I think the one thing that our teams are a little bit concerned about is the bank loan market. You know, the issuance driven by CLO demand has really created, I think it's last year, 70% of the bank loans that were created were issued to single B, because that's what the CLOs want to buy and have in their structures. And so it is created this little bit of it's an engine just driving issuance. You used to see high yield and bank loans issued at the same time. Now people are just doing bank loan only deals, which is really unique. High yield issuance is down over 80% year over year. So as Jonathan said, there were 12 deals yesterday. There has been more deals in the IG space recently, but in the high yield space, no one's coming to the market. So the high yield market's actually shrinking as an overall market. The bank loan market continues to grow. So I think from our perspective, some of our teams, they are concerned about what's happening in that market. They're starting to see if there's, you know, it hasn't broken yet. It's definitely early, but that is an area where they have some concern.
The bank loan market, does that give you the advantage of variable rates?
They do, yeah, they do, yeah. They're not, they go with the other floating rate structures. And that's why they're attractive in this type of environment. But once if the Fed slows down kind of early 2023, you know, gets to 5 and then holds, you know, our view is they go to 5 or 5 1/4 and then they stay there. They're not gonna go back down quickly. If you look at the dot plots, there's some dot plot that says Q3, Q4, 2023, they begin to cut. We don't believe that unless it materially deteriorates. I think they are going to sit there and wait and see what the long-term impacts of what they've done are. It's typically a 12 to 18 month lag from what they do to what gets into the economy. So our view is it stays higher. Our view is inflation stays a little bit sticky, and that's really driven by wage inflation primarily. You know, there's simply not enough people in the labor force at this point. So there's I think the last number I saw was 11.5 million openings and only 5 million people looking for work. So that's a structural problem. So, so we think the Fed levels off, pauses, stays early, and goes through 2023 at that kind of terminal rate somewhere around 5, 5 1/4.
Okay, thank you.
Jonathan, is there anything else in particular you want to highlight about the portfolio and where we are right now?
I'll just mention a couple other sectors. I mentioned we're constructive on credit and ABS. We are less constructive on CMBS and mortgages. The CMBS market, I think, still has a little more pain to come through. We've been very cautious in this area. We're not increasing our target, and we're not adding any new risk in the CMBS space. We're just tending to let our legacy risk run down a bit at this point. And the mortgage market, I think, has been quite a tricky space to navigate as well. Certainly spreads are higher there, and it looks more attractive now if you look at it on a spread basis. And we do think at some point some foreign buyers will begin to come in and start to purchase a little bit more in the mortgage market. At this point, however, we have just a modest overweight to mortgages, and we're cautious, still trying to figure out the direction of rates and the speeds at which those mortgages are going to progress at. So we have just a modest high overweight there, and we'll continue to wait till a better opportunity to add more mortgages. On Matt's point, inflation, I agree with Matt that we do think inflation is going to be very sticky. I think you can continue to see some very high CPI prints for the next few months. We recently, a couple of months ago, we took a real in-depth look at some of the components of inflation, particularly in shelter, both primary rent and OER, owner's equivalence rent. Those are measures of how much it costs to rent or to own your house, essentially. And the thing about those is those are especially sticky components. For OER, it takes about 6 quarters for the effect of that to roll off of CPI. So in September, or I think in early October, the September data came out and the CPI priced at something like 8.3%, which was a very high print. And the equity markets were actually surging and going higher that day by 3 to 4%. We couldn't figure it out. We're all kind of scratching our heads there, saying, hey, inflation's so high, why are equities rallying in this environment? And as we talked to some of the traders, they said, well, the Fed knows this shelter data is sticky, and so therefore they're willing to look through it, to go ahead and say, okay, we know shelter's going to be there for 6 quarters, but as long as we see some increase in services or goods, that's a positive sign that inflation could be abating, and that's what gave the market the signal to trade a little stronger that day. As I looked at, it's a big question on what the Fed's going to do. I think Powell has been pretty adamant that he's going to continue to fight inflation. Certainly in his presser last week, he was in the camp of no, it's not time to pause. We're going to continue to raise rates. We've got to combat inflation. We're moving into a period of data dependency at this point, and so it'll be interesting to watch the data between now and the first quarter to see what happens. But I think he's made it clear that they're willing to upset the unemployment rate, the job market, maybe even the housing market in order to combat inflation. And so we do have to wait for some of those numbers to roll off.
Jonathan, just kind of a personal view on your standpoint with the Fed. I mean, obviously, they're trying to attack the demand side and force inflation down, and seems to be a little bit less attention to the money supply. Just from your standpoint, if you were king, what would you be doing?
You can go to Hawaii. Wait a minute, he's already in Hawaii.
He's already there.
I think you continue to just raise. I think they have the right approach. I think you attack the rates. I think you increase the Fed funds rate. You be consistent with what you're going to do. I don't think you play around with the balance sheet too much. You don't get as much bang for your buck that way. And I think the messaging on the Fed funds rate will be the primary tool to combat what I'm trying to do.
Thank you. Any other questions?
In case I have Mr. Schroeder, what is the yield of the portfolio currently?
It's in the book. It is on slide 26 right now. The portfolio, it was 493 as of 9:30. Jonathan, do you think it's slightly higher than that at this point, or about that, so about 4.9?
I actually have 522 here in my book, Matt. I don't know if we're looking at the difference between the...
That's the average yield. You have yield to worst?
I have average yield in my book, but the number you have there looks right, 493. That would be reasonable that we would have a modest yield advantage over the benchmark, primarily due to our ABS overweight at this point.
Do you do the bulkier buying at the original underwriting? I mean, is that when you acquire?
You mean the new issuance?
Yeah.
I would say it's a large driver at the firm level. You know, we do a lot in new issuance space, but, you know, the secondary market is as important. You know, we have probably 9 high yield traders, probably 9 or 10 IG traders, and then, you know, Jonathan and the Discipline Alpha team have their own traders in Orinda that also trade those markets. So it's, new issuance drives fixed income markets in general, and the liquidity is obviously better in that space because you kind of, you know what you're going to be able to, you talk to the syndicating broker and you get your allocation. But the secondary market is where you can find some pretty interesting deals, and so that takes a little bit more work, but we do spend a lot of time there. It depends on the strategy, really. The high yield strategy probably this year is almost all secondaries. There's not a lot of new issuance in that space.
I got one final question. It has to do, you mentioned some upgrades and some downgrades earlier in the presentation. With regard to the credit agencies, how much confidence do you have in their research, and if you're somewhat skeptical, which I think is probably healthy, how much internal work are you doing? Are you taking them at face value, or are you saying, okay, they're saying you're the credit upgrade, and you then your team going in and kind of doing their own work? So kind of explain to me how those two pieces integrate into your research.
Sure. I'll start, and then Jonathan definitely chime in with, you know, how the team does it. At the firm level, we have about 70 plus or minus credit research analysts. We have our own internal rating structure. It's LRR 1 through 4, 1 being the best, 4 being the worst. And we created what we call a unified relative value tool. And so the analyst owns that tool. So if you think about every issuer in a particular industry, you can go into this tool, choose whatever industry you want, and it'll show you kind of a relative value curve, and it'll show you all the issuers in that space, both IG and high yield, and what the Loomis internal rating is of it, what our own internal, you know, BBB plus, you know, and then how does our analyst think about it as relative value relative to the other issuers in its space. And so that's basically our credit and research analysts spend almost all their time doing that, is making sure that we're updating our research reports. And I can do a demo for you all. It's a really amazing tool, actually. But that's how they interface with our investment team. So our investment team say, well, we like this sector, this industry. Show us what you have here. They can look at the same screen that the analyst is looking at, and they can ask questions, and they can also just click on any issuer. So we don't typically, I almost have we won't put any stock in what they do, but you know, we're much more reliant on what we do and our analyst view of what the actual credit quality is. And Jonathan, do you want to add anything to that?
Sure. Well, you know, we're not beholden to a rating agency's opinion. We can certainly disagree or form our own opinion. However, it's rare that we would disagree with the fundamental direction of a rating agency. It's more likely it's an issue of timing. So, you know, the rating agency may upgrade or downgrade, and it's going to be a quarter or 2 quarters out. We're already thinking about that and trying to get in front of it. It's more often a timing issue. I'd say rating agencies are pretty transparent and open with what they're doing and when they're doing it. They try to, you know, like the Fed, they try to have that open communication so there's no surprises. So that allows our team to generally say, okay, we think Fitch is going to, you know, give a 1-notch upgrade next quarter, so I'm going to go ahead and position myself in this name now. So it does provide an opportunity to, guess, be ahead of the rating agencies when we think they lag.
And it matters a lot in kind of that crossover space, double B, triple B. When they go into and out of the high yield index, companies going down, they tend to take a really big price hit when they go down, et cetera. And vice versa going out when they come into and out of. Ford is one that's kind of sat on that cusp for a while.
I have a question. I don't want to extend the conversation too long, but sort of related to what you just mentioned. Concerning your holdings and your positioning within the portfolio and how you do trading and what would you say your turnover is? And then with respect to that decision, when you're moving out of a bond and into another bond in this environment, it seems like you're more than likely realizing a loss if you've held that bond for a while. And how are you making the decision to move out of it and into something else? I assume it's because you think that over some time period you're going to earn higher yield to compensate for that realized loss that you may be occurring. Is that correct?
Yeah,
Sure, so our turnover does tend to be higher than industry average. For the core strategy, we would estimate it's somewhere between 300 and 600%. Now, we're constantly hedging our positions with treasuries for duration management. So if we buy a corporate bond, we immediately sell a treasury. That will artificially increase our turnover to a higher level, but there's not necessarily more friction or transaction costs. We cross treasuries with the street. It's a service they provide, and it's essentially costless when we do that hedge. Now, to your other part of your question, we come in every day and try to determine the best relative value in the portfolio. And hopefully we're not getting to a point where a bond has underperformed and we have to cut it at a significant loss. Hopefully we're looking at that in a week or 2 months earlier saying, what's the best relative value I have today? Do I still like Ford over GM? Do I still like JP Morgan over Bank of America? And every single day we can switch and make that decision. Say, okay, JP Morgan looks better today. There's better relative value in this part of the curve. So our turnover does, I think when we make trades, it's more often that we are monetizing a position than we are trimming a loss. And our goal is to make as many of those trades as possible to make a quarter basis point, half basis point, full basis point, just over time and try to get more winners and losers. So to your point though, we will have bonds that aren't performing. We will have to sell them at a loss, but that's still part of that relative value decision of we believe that something else was just looked better on that day and we could swap the proceeds into that.
And I mean, when I say sell at a loss, just, because interest rates are rising, you may be selling a bond, that's lesser in value because of the rise in rates over a month or a quarter,
Yeah, that's right. I mean, we will tend to look at things in a duration adjusted, risk adjusted basis. So, we try to take out the effect of that benchmark interest rate effect and really just look at the performers.
Right.
But yeah, if we think there's better relative value in a name that versus one that's underperformed, we'll cut that.
Thank you.
Okay. Yep.
Any additional questions? All right. Jonathan, thank you very much. I hope you enjoy the rest of your family vacation there in Hawaii. Thank you for taking time out of your schedule today.
Thank you very much.
Well, thank you all, everyone, for the time. Really appreciate it. And as always, you know where to find me. If any questions come up or you'd like to have a conversation with the team, we're here for you when you need us.
Great. Thank you very much. Okay.
Have a great holiday.
Thank you.
Great Thanksgiving.
Great. Thanks, everyone.
All right, okay. Everybody good? Anyone need a break? If not, we're going to proceed. See no hands go up, we're going to proceed. All right. Brandon, you have the floor,
We're going
sir.
to talk about the good news for the fiscal year end. So we were kind of talking earlier, typically we don't really spend much time on the quarterly because by the time you're meeting, we've already had a full month plus the flash report. We kind of focus on that. Because we're meeting a little earlier this month, we don't have the October flash yet. I'll give you an update on roughly where the assets were. But I just want to spend a little bit of time on the fiscal year end report because it's one, the most recent we have, and two, it obviously is quite frankly the most important of the year because it's really capturing the results that are going to get used in the valuation and so on. Just real briefly, if you can go to page 7, again, we tend to not focus here, but I thought it'd be helpful to just kind of review the equity markets. Upper right-hand corner, really I just want to highlight the difference between the blue bars, which are value stocks, and the green bars in growth stocks. So if we just showed up and said, hey, the S&P 500 was down 5% this month or this quarter, typically in that environment, value is going to be outperforming or at least down less than growth. But as you can see in the upper right-hand part of that page, it was the exact opposite. 200, 250 basis point difference outperforming on the growth side versus value. Now, if you move to the bottom right-hand corner of the page, you can see over the last 12 months, though, that sort of traditional trend was definitely in place, where value was down somewhere 11 and change, depending on which benchmark, and of course, growth was down north of 22%. So from just sort of a relative positioning standpoint, we know we have generally a bias toward sort of value-themed managers. Even if they're on the growth side, they tend to be a little bit more defensive. So generally, the backdrop from that standpoint should be a little bit positive. I'm going to skip over the next handful of pages. Page 13, I kind of figured Loomis would talk about kind of the actual yield curve. They didn't, so I just wanted to make sure to highlight that here in the book. You can see the yellow line in the bottom right-hand corner, significant move up the page. So we continue to see these kind of gap up in terms of the Treasury yields as the Fed continues to raise rates. And of course, the bond market is trying to race out ahead of that, anticipating future rate increases. And so certainly that's been pretty dramatic. The other thing that gets talked about a lot, it's not real obvious, but the spread between the 2 and the 10, we're definitely inverted, and that inversion has been exaggerated here even in the last 30 or 45 days as the 10 continues to get lower than the 2-year. So that's kind of the bond market signaling trouble. I said there's been an inversion prior to every recession, really ever. Now there have been inversions that weren't followed by recession, so it's certainly not a perfect indicator, but it's certainly one that's being talked about quite a bit. Then I'm going to skip ahead and just jump into the results. Page 18, again, we know the environment was very, very negative. So for the quarter, top left, we were down 6.6 versus the benchmark down 5.4. And then for the fiscal year, down 20.42 versus that benchmark of 17.41. Again, the vast, well, you can see down below our equity did underperform for the year by about 100 basis points, down 18.7 versus 17.6. But the bigger reason we underperformed at the total fund level was just because of the allocation effect. Overweight to equity, underweight to fixed income, a little bit underweight to real estate. And those areas obviously did outperform equity. So when you add slight underperformance for the managers and then the allocation effect, that's how ultimately you get to that underperformance of about 300 basis points for that 1-year period.
So that which was doing us a big service 24 months, 36 months ago is now biting us here.
It did, yes.
What does that tell you we need to do going forward? Do we need to reallocate any based on this recession you see coming?
So that's the interesting question. It's how much of these numbers that we're looking at are already pricing in that recession.
Okay, I see that.
And that's
the answer is to some degree, but probably not enough.
Possibly. And it comes, I think it'll come down to a timing. Interestingly, Loomis said they think rates are, the Fed's going to raise probably until March, and then plateau. Virtually every other bond manager that I've been speaking with over the last couple of weeks is saying by September they're cutting, and that's what's actually being priced in.
By September of this year?
By September of 23.
23, okay, yeah, okay.
Rates are on their way back down. Housing is slowing dramatically. Really, everything is slowing dramatically. Most of the cuts that have already been implemented, again, as Loomis said, they take 9 to maybe as long as 18 months to truly work their way into the system. So the first cut in March is just starting to work into the system, and they've raised 3/4 of a point 4 times since March, and so there's a lot more calming or cooling impact from the rate cuts that were already done that really haven't worked their way into the system yet. Yet again, housing is slowing, commodity prices to some degree have certainly softened, and there's a lot of signs again showing that things are slowing down pretty
What
quickly.
your bond market friends are telling you is that they think the recession is going to be either over or on the way out by September.
No, not necessarily. What they're saying is the Fed is going too far too fast.
That's the first person I've heard say that it's not
really.
that they're not going to cut at some point.
That
Which is
they-
interesting. I mean, I don't disagree. Maybe I'd have to think more about it.
But I think
It all depends on what the economy does,
Sure,
right? And
absolutely.
Yeah.
So, yeah.
I mean, I can say if employment stays where it is, it's going to be hard to think that, things slow down to a halt,
correct. That's the one, at this stage of the cycle where the Fed is raising like this, you tend to have more cracks showing in employment than we have had so far.
Correct.
And that's the big guess out there. Does it hold up? Or do all of a sudden we start to, read about, 1,000, 2,000 people getting laid off by these larger firms? Is that coming? We just haven't heard it yet.
Yeah, we knew that answer.
Again, interestingly, this is actually an emerging market debt manager that I was with a couple of weeks ago. And his prediction was, again, in line with the Fed continuing, they're going to dwindle, probably 50 next time, then 25, and be done, kind of finish in March. But when we get from, say, January to March, that's when he was predicting that the actual news items that were coming out were going to start to get very negative. That's when the, layoffs were going to be a lot of negatives. And so by the time you were getting that negative news, that's when he thought the market would actually start to respond better, because then they're saying, okay, now we're actually getting the bad news. The Fed's completely done and likely to have to cut, and therefore we're going to start pricing in the cuts, and that's when,
I mean,
again,
market's always 6-8 months ahead of what really going to happen.
Right, and that's the hard part as we sit here today, long-winded answer to answer your question.
Yeah, how do we allocate?
Normally, when we come in and we see pockets of the portfolio that are down 20% over a year, there's a wonderful rebalance opportunity. This is the first time in a really long time that we don't have that chance. You come down, equities, and I actually have a chart, maybe we'll just jump to it, this single page handout that you have. This looks at the last 45, 46 individual calendar years, where equities are on the vertical axis and bond returns are on the horizontal axis. And what you'll notice, certainly, below the line, there have been plenty of years where equities have been down, some more than even we are on the year-to-date basis. But not once have you had both equity and fixed income down like this. That's what's so unusual. Again, typically when your equities sell off 15 or 25 or 35%, you've got a huge overweight to fixed income because it's up 20% or 25%, and so you can rebalance that portfolio back in. But in the current environment, I mean, fixed income's down, not quite the same, but it's close, and so it doesn't really create that rebalance opportunity. So ultimately, to answer your question, I think the answer really is staying to the policy, keeping the allocation where it is. The one other consideration or thing that I would throw out there now, and that's the reason I wanted to make sure they highlighted the yield question. So when we were investing a couple of years ago, like the pension obligation bond proceeds, we wanted to stay away from fixed income, rightly so, because you were getting no yield and the prospects were for higher rates. That portfolio was yielding 1.5% to 2% back then. It's now yielding north of 5%. Now maybe that gets a little higher, but it's starting to get some real yield, and there's even a prospect of maybe rates, coming back, lower here over the next 18, 24 months. So that's the one thing I kind of throw out there. I don't think there's this immediate urgency, but actually getting back into a little bit more fixed income, even relative to policy. I know we took a lot of monny out of fixed income just to meet the obligation.
That's part of because
but just
his really lucky withdrawal.
But that's something to kind of
They might
start
have saved a
mulling.
few basis points, but it didn't, I mean, overall, year-to-date numbers, it didn't have much of an
That's
impact.
true, that's
Yeah.
true.
But that's something.
Okay, I hear you. Stay the course. Try to put something back into this where we took it out, which makes perfect sense. Otherwise, you shouldn't have had it in the first place.
But interestingly, I mean,
Okay.
a lot of the.
I'm just trying to figure out when the growth stuff's gonna start working again. When does that happen? And I think the answer may be 24. Maybe change of presidency. I mean,
It certainly
it's
could
that
be.
simple. Right now, there's no confidence in this market anywhere.
Correct. I definitely agree with you. The one caveat that
I
I
don't
would
think
give
today is
though,
gonna change that necessarily.
I would, interestingly on that, and I think we talked about this last time, every mid-year election, mid-cycle election, 12 months later, the market's been higher.
Oh, yeah.
Every single one since 1960 for sure, and I think it actually even goes back to 50.
1950.
So from a historical backdrop, you know, the timing or where we are, it lines up well. Of course, we've got some huge geopolitical issues and obviously fundamental issues with the Fed and everything else that are kind of standing in the way. But on the growth side, again, if the thesis holds true that the bad news gets bad, or we should really start to hear that bad news, the Fed has finished cutting rates, and then we're that much closer to the Fed cutting later in the year, I would guess that, you know, springtime, you'd start to see some more of a rebound in the quote risk part of the market, you know, the growth equity and the like.
And I think the idea is not to try to market time, but, you know, you still want to try to pick your times, you know, we're not day trading or anything like that.
No.
But, you know, in the first quarter or second quarter of next year, you know, see where equities are, give the Fed a chance to top out, and then maybe put some money in at the higher rates, you know, in fixed income then, depending on what's going on in the markets. And we're only talking about 20 or 25.
I'm comfortable with that as a philosophy.
20 or 25 million, you know, again, when you only have you know, between a 5 or 10% allocation to fixed income, it's not going to have a huge impact on the portfolio. It's just, you know, moving the margins around. But it's still worth doing.
But, yeah, because of the stabilizing influence.
And should we look at bonds, this Loomis position, I know they haven't changed their discipline, but is that not a very valid discipline right now? I mean, you go out by $100,000 CDs all day at 4.03% or 4.23%. And when I'm looking at page 18, I don't see how their yield is 4.97 when, is that better than the losses? Is that the way it's based? They
That's
lost
their yield, not
losses.
their return.
Yeah, just the actual cash coming off of the positions or the bonds.
So that's the coupon they're earning.
Yeah.
So they're earning a higher coupon, which went to my question about, you're selling a bond in a rising rate environment at a lower market value probably than you bought it at. So you're taking a realized loss. Why are you doing that? It's to position into a bond that you think is going to yield more and perform better and maybe have a chance for a ratings increase over the next 6 or 12 months.
Dave, I had a question for you. With the insurance company industry that you're affiliated with, what are you seeing in terms of insurance companies in general, regulatorily, have to keep a lot of money in safe stuff?
No, what we're seeing
Yeah.
right now is that, in fact, I was just doing budgets for next year, and I'm plugging in 4 on a yield on that, because I think the Fed numbers are going to be up almost the whole year. I could be low on that, as a matter of fact.
What
But
type
see, I don't go into equities or anything. I can't.
Right, I realize.
Yeah.
So I guess how much is your bond portfolio that had been marked down without giving inside information? I mean, have you seen, I mean,
I'm not sure I understand your question.
so how much did the bond portfolio mark to market? How much damage has been inflicted on your balance sheet?
Very little, but that's because, if you recall, I only got my infusion on September 1.
Shoot.
So we've done.
I got you.
All I've done since then is watch it do,
Gotcha, okay.
The question is, how optimistic do I want to be in my relative sector? I mean, this is not exciting.
Right.
This is like this whole Loomis thing. They got all excited about, this is fixed. Ah. So,
Okay.
let me put it to you a different way. I'm covering my costs.
Okay.
That's all I care about right now.
Good deal.
So getting back to the quarterly report, I just kind of wanted to highlight one other thing, to be quick. If you just go down the 1-year column, and I'm on page 19, which is where all your individual equity managers are. So we mentioned how value did outperform growth for the year. 5 of your 7 managers did outperform. Unfortunately, the underperformers, Brown and Bailey Gifford, were rather sizable, so that's really what hurt the overall portfolio. But in actual numbers, you had more outperforming than underperforming.
Bailey Gifford is a killer.
Brown was not too shy of that either.
Yeah, that's true.
I mean, and these numbers have changed very little from what we were talking about last time. If those numbers were through August, and so again, this is mostly what we had talked about, and Bailey Gifford was here last time discussing these numbers. So certainly painful, but probably a lot of kind of pent-up relative value. That's what I've seen with Brown, with some other managers that I consider similar to Brown that have been hurt virtually the same. Any manager that kind of is what I call, quality growth, relatively concentrated, every single one is down more than 30% in the last 12 months, underperforming the benchmark. It's not like Brown or these other folks are out on an island by themselves. Every single one of them is down north of 30%, at least the ones that I've come across. But interestingly, the fundamentals of the company are performing very well. A lot of the growth, still positive growth rates, yet you've got, essentially it's just multiple contraction. That's where they're getting hit on.
Yeah, I mean, that, as to your point earlier, March timeframe, if the Fed decides to stop and things, bad news and whatnot, I mean, those companies will recover first as well, and significantly, quite honestly. It's just, can you bear the pain while you wait?
Just
You
don't
find
look
the
at
right
it.
ones and buy them.
And like I said, I mean, I wish, there was significant relative outperformance and underperformance in different parts of the portfolio, because it would give us a bit more opportunity. If we had, an extra 5% in one piece that we could say that had done well, and we could potentially rebalance and do some other things, but like I said, just the way
It's not there.
everything has come down, it just hasn't given us that opportunity, like COVID or. some
Nevertheless,
of those
that's the
markets.
question this group needs to ask itself from time to time, so
Right.
thank you for the answer.
That's everything that I wanted to cover in the quarterly. Let me just give you, so again, I hope to have the October flash to you maybe by the end of the week, first part of next week, but just rough math with what we've seen so far. It looks like we're going to be up to around $542 million versus I think it was 517 as of the end of September. So we did, roughly a 5% positive October. So as painful as this was, obviously, things have gotten a little better. Been a little bit more mixed here so far in November, but hope to have those final results to you here fairly soon.
And we'll refresh my memory on our smoothing, it's a 5-year smoothing, so we'll pick up 20% of
Yeah.
this fiscal year, okay?
Yeah, and I'll have to go back and look. I mean, the good news is that the fund was overfunded. I think we were at like over 110% funded level. So I'm hoping it doesn't reduce that down. I can ballpark it and let you know.
And you have a
market value of 9/30/21
9/30/21. I can tell you in a second.
It was at the scroll to the top. 516,
So
846.
you said 517.
9/30/21.
21.
Oh, 21? It was significantly higher. I mean, it was 23% higher, or 20% higher, so it was over 600,000, 600 million. Yeah.
I've got the report, I'll just get to the page. 693.
Yeah, almost 7.
Now, part of that is also distributions going out, so it's not all market value loss, but.
Yeah, and, on the withdrawals that we made at the end of the fiscal year, we may have, taken out a few million more than we needed to, just because I didn't have real good accounting numbers on the pension plan, and so I was sort of backing into how much
Hedging your bet.
we needed to take out based on our contribution and benefit numbers through our actual evaluation data. It's just part of this ongoing issue we're having with the Workday system that we're using.
I was just trying, ballpark in my head what I think the impact's going to be when the 22 val is done on that contribution.
It'll go up.
Yeah.
It's going to go up,
Going how far?
but we'll see. And kind of on a related note, just to make the committee aware, the finance director has decided that we don't want to allow the pension plan internal cash balances to go negative any longer. So what that means is I'll be doing quarterly withdrawals from the investment account rather than one at the fiscal year end. You know, what that'll do is sort of moderate volatility, you know, if we do 4 withdrawals a year instead of one big one. So instead of doing one, say, $30 or $35 million withdrawal at the end of the year, we'll do 4, $8 or $9 million withdrawals during the year, each quarter. So just a little more activity, and it's always sort of painful to deal with State Street, but
Have they gotten any better? I know a couple of years ago, they had some real problems. Are they improving at all, or is that still?
we've got some pretty decent people that work with us now. I won't say that it's problem-free, but the response I get now is much better.
Okay.
If I send an email, I get a response the same day.
Okay.
And in the past, you know, we'd have to send 3 emails and we'd get a response a month later, you know, so.
How do you decide where to take it out? Which accounts to take it out of?
Well, we discuss it here, and I talked to Brendan. We're typically going to take it, we're going to use it as a chance to rebalance, take it from whatever's performed the best, and, you know, rebalance that way. We ended up taking a lot out of fixed income because it had performed the best by losing the least.
And
By the
equities
way, I
were,
meant to ask, what is Lewis's fee?
they're on a performance fee, if I'm not mistaken.
What are they? So they're paying
Penny.
us.
Let me-
They're not paying as much, but they've done, what, about 5 million is what they have? You have after the withdrawal?
Yeah.
Yeah,
Yeah,
it's
so-
way down.
Yeah.
Which, to be honest, I'm surprised they wanted to come in person for $5 million. But,
Yeah, I that thought went through my head. Wonder why he's here.
I'm sorry, it is not, they're not performing, it's 23 basis points.
23. Now, do we look at that regularly? I mean, in terms of what the competitive for the fixed income managers?
We haven't been actively talking about it here. Certainly, our firm and all the folks covering fixed income out of research are always looking at that. And then, you know, if there were to be a situation where somebody is an outlier or something like that, we start to have discussions. And then that would get kind of pushed to me to say, okay, you know, hey, we've got exposure with, just to use this example, Loomis, and they're now high or whatever in the marketplace.
Our experience was that if we, you know, sometimes you compete not just because somebody's underperforming, but you compete for the knowledge and for the pressure on the fee. Oftentimes you pick up a couple of basis points, just letting them know that you're looking at options.
We utilize a lot of funds with your plan, and so you don't quite have that same opportunity if it was separate direct relationships, like direct separate account. They can negotiate those, but within the fund, they have to treat the investors the same. And so you're going to have a one fee level for each
But
investor.
how long, for example, Brian, would the 23 have been in place? I mean,
I think since we hired them.
Since we hired them, yeah.
so there's been no change in
Yeah.
that?
And I mean, at your asset level in fixed income, I think that's very reasonable. I mean, to me, the going rate for fixed income of call it a $20 or $30 million portfolio is 25 basis points. So I think 23 is obviously slightly better than that at average. Now, we have some portfolios that are allocating 500, 600, 700 million to fixed income. If you're doing that, then I think 25 is too high. You know, it's a different discussion, but at your asset level, at commitment level, I think that's a reasonable
We may
fee.
still be working on the rate we got when we initiated.
I don't know where I would think this, but Twin is the only performance-related fee that you have, as I recall.
Correct, yeah, now that I
I wouldn't bet the farm on that knowledge. but-
And just for if you ever want to know, within the quarterly book, we do include the fee schedule. So it's page 91. Again, typically, we don't look through that enormous book.
So I didn't see net of fees this
Yeah, I
time.
didn't see it.
In
The net fee
in the
results,
book. Yeah, I didn't see net of fees.
there's the fee schedule. It shows obviously the asset level and then what that, now again, this is static. This assumes, like you see up at the top, the estimated annual fee.
Yeah,
That's if your asset level didn't move from there and stayed exactly for 12 months. That's what it would equate to in dollars. You will pay either more or less than that. hopefully it's a lot more, because your assets have gone up,
Right.
right? But it does, and that gives you a breakdown by portfolio.
And Twin hadn't made any money off of us ever, is that correct?
Correct. And that's why we're showing it as just blank, because
Yes,
the performance fee has not, it's not engaging.
So they must have some clients that are paying them fees though, right?
Yes.
Twin?
Yes.
I think we've asked him that several
They
times.
take contributions.
Yeah, but I'm not joking now, 24, 36 months from now, Twin may be glad they did that way, so.
Yeah,
I'm
I mean,
optimistic.
they've done the calculations, and they come out on average at least equal to, if not better, with performance fee.
Sure.
That's how they set
They
those
should.
calculations.
There
But
should.
but-
There should be some sort of a bonus for doing it, for taking the risk.
right, but timing.
Timing was not their best effort, no.
Correct. So that was everything I wanted to cover in the quarterly. I've got two other items for you.
Yep.
We already talked about the matrix. The other one is this
Those are
bull and bear
fascinating
chart.
charts, those two charts back to back.
This-
There's one on the back too.
Oh, yeah.
There are two charts there, yeah.
Yeah, because so this is, the second chart is in a way similar to that S&P drawdown chart that we've seen.
Yeah.
But this is the bull and bear chart, and again, we've kind of talked about this already, but this looks at every bear or bull market since the end of World War II. In the green box up at the top, you've had 14 bulls. The average gain is 155%, and the average duration is 53 months. Of course, every bull dies with a bear. We've had 14 of those. The average drawdown is 33%, rough terms, and the average duration is 13 months. So here we are. I think the low, we're down about 28% from the peak, which was January 3rd, and we're now 11 months into this bear market. So obviously, if you look at the individual markets along the bottom, the individual components, some of those bear markets last 3 years, some last 6 months. Some have a shorter or lesser drawdown, and some obviously have more. But just if you think about the averages, we're not quite there in both drawdown or duration, but we're close. And just sort of interesting, that March timeframe that we've been talking about really coincides really closely with that kind of, those average periods
You're
in
not
terms of
at,
duration.
you're not at the bottom of the market, but you can see it coming.
Well, and again, we don't try to time, we're not predicting that it is the bottom, but just to put it, again, there are a lot of folks that when they see negative news, that means it's going to last forever. And what I'm trying to sort of illustrate is this happens fairly frequently, about this level of duration.
I see positive news.
And
It doesn't last
that
forever either.
hopefully means we're closer to the next bull as opposed to a bear that lasts 10
We
years.
expect a bump by the end of the year.
It would not surprise me if the market was fairly positive for the next 6 weeks.
Yeah.
Especially when we get clearer today. If there's a split in Washington after today, that is the ideal scenario for markets, if you look historically. They don't want one side being in power. If you get a split, that's the best.
Whose work product is this? Is this an ANCO work product?
Yeah, I mean, we source the data.
Who's it I talked to him, Bloomberg.
Yeah, this
Yes,
is Bloomberg and, yeah.
No, but the internal, that's of Excel, what's his name, US Census Reports.
Dan.
Dan, yeah, he kind of puts together.
The best news, it seems to me, is it's worse news every place else. I mean, when you consider what's going on, or likely to go on in Europe and now in China, I mean, there's gotta be a flight to safety here, if nothing else.
Well, there's been a flight to say, I mean, the dollar is significantly higher than it's been. Our rates, generally speaking, are higher than a lot of the rest of the world. And again, getting back to this EM debt manager, so there's a lot of dollar connection with EM debt, but and it's getting very nuanced and specific to him, but he was saying, okay, the general macro news is going to be really bad through March. But at that point, he thinks when the Fed stops and the rest of the world has to keep raising, at that point, the dollar starts to significantly go back the other way. Again, just only time will tell. It obviously depends on a lot of things, and there's a lot of time between then and now, but.
And I've got
Oh,
one
not
question.
much.
But I got a question on this chart. So I'm trying to read, I get the stock plot and the blue dots. The green dot, because you had on the, I guess, the y-axis is the Bloomberg bond. So
Yes.
you only just plotted, for the 1 year. So you
Just the 1 year,
Just
and the relationship between equity and fixed
got it.
income
Okay, that's what
returns.
it was. Okay. that's
With the idea, I mean, essentially, we've, in the last 45 years, back to this one, we've not seen a year where both equities and fixed income have been down anywhere close to this.
Right, right.
And now granted, this isn't a full year, there's still 3 months to go at the timing of this being created. But the short
Yeah,
version,
but
we're kind of.
that green dot may move to there, but that's, I mean, the 3 months.
Unlikely,
yeah.
but yes. But essentially, the message was we're in kind of rare territory here,
Yep.
where both equity and fixed are negative like this.
It's good to have visuals.
And Greg, you had a chart up there I was looking at. Was that in the slide deck? I don't recall seeing that. You had a chart, it was in the mountain chart. Was that in the slide deck?
Yeah.
Something different.
We had sent it out, I just didn't bring a print.
Okay, fair enough. Okay, then I
So
saw it.
this is the S&P drawdown chart
You
that
changed
you've seen.
colors. Yeah, you changed colors.
I don't know why, but it went from red and green
All right,
to, or kind of pink, to green and blue. But yes, this is just the updated
This is
version
the one
of
we
what
see
you.
periodically.
Yeah, gotcha.
Yes,
Whereas that's new.
that's new, but if you go to the back side, this chart looks an
Yeah.
awful lot
That's
like
that,
that. Although this goes to 45, that only goes back to 2007.
Oh,
So that's the last 15 years, this is the last, 70 years. But again, same general message. You have negative periods along the way, but the periods of growth more than outweigh that, and that's how you compound assets over time.
Well, these type of visuals helps to kind of counteract, the recency bias and cognitive. Bill always put a great way in whatever happened most recent. They get hung up, be it good or bad. And so this is always, you zoom back out, so because let's get some perspective. It's always helpful. So I appreciate the time and effort you guys put into this.
yeah.
The only other item that I had for you, we kind of queued up the conversation last time about real estate. We talked a little bit about open-ended value add real estate. And then the next stage of the conversation, which I have information for you today, is on the kind of the closed-end, more opportunistic. And so continuing to walk farther out in sort of the risk spectrum in real estate. And so again, I can just introduce this, see what you guys kind of think about where we are, if there's any interest at all, and then just sort of start that conversation. But let me, in the book, I'm on page number 2. And again, you'll see these are June 30th numbers for these closed-end portfolios. You're always kind of operating at least a full quarter behind in terms of the data. But we have 5 managers that are currently kind of
I don't
open
have this. Go ahead.
fundraising in the real estate space. Mavic, Pennybacker, Angela Gordon, Artemis, and Torchlight. Again, I'm going to try to be brief, just sort of hit some of the highlights. I don't know if it's helpful to kind of go through on page number 4, just a quick snapshot of the different kind of capital stack within real estate. You've obviously on the value add and opportunistic on the right-hand side, you've got an equity component, you've got the mezzanine debt or lower quality, and then senior debt below in terms of that's kind of the quality or cash flow priority scale, which of course is flipped from a risk and return standpoint. The more you are on the equity side or in the mezzanine debt, the higher return, but of course the higher risk. If you're senior loans, obviously you're more well protected, but you also get a lower level of return. Just flip to, I guess, page number 8. So within these 5 managers, there are actually a few differences. So Mavic and Torchlight, the top and the bottom, they're not really investing in the real estate itself. It's more around the debt. So it's real estate debt. They're backed by properties, but it is more of a debt type fund. Again, very similar targeted return on the far right hand side. You'll see kind of mid-teens for Mavic. Torchlight's a little lower, low double digits. And then Pennybacker, Angela Gordon, and Artemis, those are more the traditional, actually in the ground, doing the real estate development and or value add type portfolios where you buy a distressed property, maybe fix it up, reposition it, and so on. Again, just kind of for,
Is there a benchmark that coincides with the targeted returns? Because some will make up their own benchmark, which to me is like,
yeah. I mean, really the benchmark is more like the peer group of funds, but one thing that's where it gets really challenging in closed-end funds, you know, a 2015 vintage year fund, you can't compare with a 2017 vintage year fund because of the timing element of the investment process. So what you almost have to do is just create a subset of like the 2015s and compare against those managers that were raising and deploying capital at the same time. Now in the open-ended world, where those are all funds that are continuing to operate, have assets, yes, they're adding and selling, you know, off the portfolio, but they have a core holdings that are they're being held over time. Those you create essentially a benchmark out of that pool. So that's like the NCREIF, the Odyssey.
it's just my experience, they've been very generous in their estimates.
You mean in terms of what they're targeting for IRRs?
Exactly. And you're tying up as long as 7 years.
Correct. That is the downside. There, I mean, these are locked up investments. So it is very possible that we're not interested. Okay, so I want to always throw that out there. I'm not saying
I like that one.
this is something that needs to be done, but the thought, and here's kind of where, from my standpoint, the conversation is generated. We've got an existing allocation to core real estate. I think we all see some of the writing on the wall with interest rates, that the real estate market is going to be more challenged in the future than it has been for the last 5 years. Now, if there's a scenario where real estate, or at least pockets of real estate, are more significantly challenged, this is the type of vehicle that could better take advantage of that. So any open-ended strategy that you have, you're coming in with an existing portfolio that, if there were to be write-downs, is going to ride that wave down. These closed-end strategies, in these funds, there are no assets. These funds don't exist yet. So if you're deploying capital into new investments, are they buying things depressed 20%, 30%, you know, from where they are today? Because these dollars are invested 2 and 3 years from now. That's sort of just the idea, or the reason I thought it would be worthwhile to bring it to your attention as a potential consideration.
The market changes so much.
Yeah.
Like 6 months ago, everybody's buying warehousing space.
Yep.
Apartments were dead. Now nobody can afford a house, so apartments are hot.
Yeah, I think the REIT market's telling you a lot about real estate in terms of.
Was it down 28%?
20, yeah, because I don't see anything good. And you got to worry about the Florida bias, okay? Is that things are better in terms of real estate in Florida. We sold a lot around the Washington area and in Texas. And those brokers are calling me today saying, man, did you time it right? Okay. You don't hear that so much in Florida.
Right.
Because there's such an influx of demand. But it's terrible. Some other place. I mean, how can the real estate market sustain these kinds of increases in debt? I mean, it's just, the rates have just gone through.
Right. Well, that's the coverage is going to be an issue, and that certainly, I think one of the things that it's helping it hold up is the employment that we talked about earlier. But when that starts to, if and when that deteriorates, that really doubles
Aren't
down.
you starting to see that in the high-tech sector in terms of employment?
You are, yes.
I mean, they're now becoming much more cost-conscious, and disciplining the cost. And all you gotta do is look at the Facebooks and things like that.
Right.
It's either here or it's coming.
Right.
Okay, but the real estate market is just.
Downtown San Francisco, the official unrented property percentage is 36%, and on the soft, because what they're doing, it's more like 45.
Yeah.
Because they're doing, a lot of our people are saying, we're going to sublease out our piece quietly to you, give you a good deal, but some of those markets, it's a disaster.
A lot of that's crime related, right?
Well, San Francisco has screwed it up so good. I mean,
My sister sold it.
but the answer, compared to Florida, right? Because Florida is on the other side of that
It
spectrum.
really is, because you don't hear, it's not as negative, but it is getting that way.
Well,
In terms of, values.
was talking to a friend and a client of mine who runs a large hedge fund out of Atlanta. It's affiliated with the Georgetown Group, which is a lot of the Rockefeller money out of New York, big private practice. And he makes lots and lots of money on his fees for these development. He said, well, Vish, you know, I'm gonna get my fees. I'm just not sure how well the investor's gonna do in the long run. And so I mean, you know, I appreciate his honesty, and I'm like, yeah, probably, you know, but some of the, you know, private stuff, and this is, I don't know, that anecdotal conversation, I'm like, you know, my little antennas go up like this, and like, that may be something we need to pay attention to.
And when you look at the development market, John,
Yeah.
talking about, you know, the opportunities for the value in it, those guys are carrying large inventories of real estate. The debt has just gone way up on, okay? And I was kind of surprised, he said, you know, in terms of recessions, the vulnerabilities in energy. Talk about the financials, you know, because I keep on going into the bank saying, you know, getting any REOs yet? And there is a day coming
Yeah.
where that's going to, it just hasn't happened.
Well, I was talking to a banker, a big commercial guy here in North South Georgia, and he said, well, how's it going? He said, well, it's going okay right now. I said, well, he said, you know, the problem is a lot of these smaller loans. He said, you know, the cash flow worked at 3.5, 3.8. When it goes to 7, we're not renewing, and a lot of these companies are dead when that happens. He said, so he said, first quarter next year, there's going to be a lot. He said, I'm going to have a lot of unhappy conversations. He said, and the math just doesn't work. And so, again, you kind of laid that out. How much? I think the over-indebted, weaker hands are
Well, you
going to
layer
get.
that with recession, and you got a problem.
You got a real problem.
Because the real question on certain things like this is, what's been the experience where we've had this incredible increase in rates so quickly, from 0 to where they are now? I mean, you know, where's that on that graph? Did it happen like that
It's in
during
the
the
70s,
Volcker
yeah.
times? Did it happen? Did they actually increase like this?
994 a little bit, but no, we never had it
Not like that. Well, and here's the other thing about it. It's one thing, even if you say from the late 70s into the early 80s, you had similar rate increases, but you were starting with an 8%
See, that's
yield.
the key.
It's one thing to go up 500 points
Yeah.
when you're starting at 8. When you go up 500 starting at 0, that's a different scenario.
See, I think John's got it, is that when these things get repenciled as they adjust the rates, they're just not gonna work. And so the inventories are gonna have to be diminished, and then that's when your opportunities, but they're still a long ways off.
Well, and that's, again, that's the thesis
Yeah.
for something like this, that they're fundraising for the next 12 months, and then they've got a 3-year investment window. So, you know, sort of the thought is potentially, there's no guarantee, but potentially you're going to have dislocation sometime, you know, 6 months to say 48 months from now, when these type of closed-end funds are actually deploying capital.
Yeah. It may very well be the REIT market is telling you more about the future of real estate than the private equity. I mean, these guys don't, you know, they don't adjust that quickly.
Well, the valuations aren't being, so last quarter, the valuations by the third party that they have to do were still holding up, kind of flat. Now, the numbers that I'm hearing about for the next quarter, office here in Florida down 10+%. And so it catching up to REITs. You know, REITs, because they price daily, they go down quickly, and then the private stuff catches up over the next 9 to 12 months.
Because your argument when we asked that question, you know, a couple of meetings ago, was that, you know, the REITs are much more volatile, you know, being the stock market.
Yep.
But maybe it's just you don't know the truth on private equity.
Well, there's a
Okay.
lag, there's always a lag.
Yeah.
Yeah, and you know, maybe the opportunity is going to first show up in you know, in the public markets than here. Trump's getting sued for pumping the book on his values. You know, I think there's going to be some more of that going on.
I mean, I think if you're trading one open-ended strategy that has effectively the lag impact that we're talking about for another, I don't think you're gaining anything. What I'm talking about is these type of strategies, you're not coming in with an existing portfolio, you would just be buying in properties into the future.
And maybe buying at the bottom.
And buying somewhere near the bottom in a distressed situation.
But whose value is it at the bottom? it's theirs, isn't it? Isn't it, it's individual valuation.
Well, I
Well,
mean, it's the price they're paying for the property.
It's the price they're paying for the property.
That's
the market.
Going up from there, it's.
Well, what about their
but
current book?
They wouldn't have,
There is no
Oh,
such.
this is,
there
this
is-
is.
These are
okay.
new
These are all
funds.
so just to give you an idea, and I'm sorry to make you jump through, but like,
All right.
go to page 16 of the report, I just look at Pennybacker, the first one. So they had Fund 2 in 2011, Fund 3 in 14, so on and so forth, okay? So that fund is a silo. It has, when they open the fund, there's nothing in it. Okay, they raise capital, then they have, 36 months or so to actually put that money to work. So you hang on to your money until they're ready to actually invest it. They call the capital from you over a couple of years, and then they invest it, and then they ride that out for the next 4 to 5 years, harvest it out, sell it off, and return capital. That's the structure. And so every fund is new, and it has no assets in it to begin with.
And there's no market for that in the meantime.
No market for it.
In other words, if you bought into that and you made the commitment, then you made the capital contribution, 2 years into a 4-year project, can you sell out? Is there a market?
At a discount. You could probably find a buyer, but you're going to have to take a
The
pretty good
haircut's
haircut.
really so, okay. All right.
And so again, this
All right,
is,
if the answer is no, there's no market,
Right.
that's the answer.
the idea, and whether it's private equity investing or private traditional debt or private real estate, where in a closed-end vehicle, you don't make significant commitments, and you make sure you can weather the time and not need to access that capital.
I guess it comes back to, what is the role of real estate in this portfolio?
Yeah.
And it was a bond proxy, yield play.
So this is different.
Exactly, so we're changing the risk profile with a plan that already has plenty of equity and volatility
yeah.
risk.
Yeah.
And so
We're
I guess-
already into real estate,
Yeah.
maybe as far as we want to be, I don't
Well,
know.
my question is, should we look at selling some of this real estate
Well-
and maybe going back to bonds?
What's the cap rate now on our bond principal?
I don't know, but
I
it's
bet it's-
probably,
4.5, 5-ish?
Yeah, in that range.
So
It's
now you
coming
start
down.
asking yourself from a risk review, are you, I'll buy some freaking 2-year T-bills and wait for the blood in the streets and then go, I mean, again, it's a legitimate question, but the cap rates in some, even the higher quality real estate, I'm like, I just don't see the risk versus the cash flow. I have a hard
Which is
time
another
justifying
reason Brendan's showing us this.
it. Agreed, no, I hear you. But we're switching
The risk,
the risk level from a yield product to
Yes.
really an equity.
an equity problem.
Yeah.
Which if we're okay with that, fine, but that's,
But
It's a different
you also
nature.
make a very good point that one of the ideas by core real estate was the sort of the yield proposition,
yeah.
where you were getting 300-400 basis points more yield over traditional fixed income. Now you're not.
Right.
Now you're getting essentially the same yield.
Maybe that's
For
the
more
old
risk.
way, maybe that's the old way of looking at real estate. Why isn't it just another security? As opposed to a kind of a separate asset class. And why wouldn't you, particularly with REITs now, I mean, real estate during my lifetime has been securitized. I mean, so why are we still looking at sort of one-off individual real estate transactions as opposed to just being another security?
Brendan, going back to the previous slide where you had the managers listed, the two that, Mavic and Torchlight, using debt investments as opposed to actual real estate purchases and value add or whatever they may be doing. I would expect the three that are doing the traditional real estate to have sort of like a J-curve, maybe not exactly like private equity, but similar.
Right.
But with the debt investments, I mean, it seems like once they're funded, they could just go out and buy as much, like they don't have to wait for a deal. They're not buying particular pieces of real estate. They could just go to the debt markets, or do they have to wait for that debt to be written?
Well, no, I think what they're looking for, the distressed opportunity. So if they're, these type of funds that are targeting that type of investment, just think, if you committed to a fund like that 2 years ago, and then the next couple of years there's no stress, then they're going to be struggling to make those investments because again, or if they are going to make the investments, it's going to be at a much lower rate of return than they were targeting.
Right.
But in a these type of situations, again, they're looking for periods of stress, so that can they come in and buy the debt? Somebody else already underwrote the deal and is saying, I can't handle this anymore, or they've got covenants they need to get out of because the situation is deteriorating, and they can come in and buy it for 50 cents on the dollar, 60 cents on the dollar, and get back to $1, by the end. That's the idea.
They could make all their investments in 6 months if the market's,
Yes.
yeah.
Yeah, if the situation deteriorated quickly, absolutely. They could deploy fast if they found that many opportunities that look good, yes. Again, in my mind, it was more the middle three, the actual, items in the ground, true real estate, that was what I was thinking. But when I reached out to our lead analyst who covers this, he said, well, in the current space, we do have a couple on the debt side. So, we included them. But again, it's tough to know. I wanted to, at a minimum, make sure you guys were exposed to that being an option. It is completely leaving the risk-return spectrum that we've been operating in, as you said. And maybe it's something you want to consider, maybe we don't, but I just wanted to at least start the conversation. So now you kind of covered all three buckets. We've got the sort of the core income. Last time we talked about core plus, which is adding a little bit more of this type of situation, but in an open-ended fund. And then this is kind of the extreme closed end where you're isolating those investments, you're locking them up for 5 to 7 years. But then again, in order to compensate you, we're expecting a bit more return. So happy to talk about this more, or we can forget about it, or bring it back up at a later time if we are interested in hearing more.
I think it's one of those things, one of those opportunities sitting on the shelf that we didn't think about. I guess I'm more kind of questioning William with the principal, which is, they've done their job. My recollection, when we had a little stressful in 2008, they locked up for a while. We were able to actually get out in front of the line before they closed down. I would hope we don't have another 2008 type of event, but at this point, given where we are in the yield, do we want to start to consider repositioning principal into a more traditional yield bond, high quality bond? I'm raising the question.
The only thing I would say about that is if you think the Fed's going to continue raising rates until the first or second quarter, putting money in bonds right now. I mean, it's one thing to buy in actual bonds and just hold them,
right,
and not care about your mark-to-market unrealized loss. But to buy into a bond manager, they're going to be like Loomis trading, and so they'll be realizing losses over time, I think.
Like any laddered strategies where we're actually able to hold the bonds to maturity, just kind of ladder up. And I don't want to get too cute, but I'm not overwhelmed with the yield on most REITs and the bonds now.
Well, I don't think it's a bad idea. Maybe just look at it in the first quarter of next year,
okay,
rather than right now.
Okay.
And and also maybe revisit these, the value added and the closed-end stuff as well.
But you got mortgage REITs too.
Right.
Okay. I mean, I think there's a lot of permutations of real estate investing now. Just like, you can invest in private banks, okay, but typically you invest in securities of those banks. That has developed better in the way than real estate has. I just don't understand the attraction of private equity when it comes to this.
I think the primary difference of the way I view it is, I think over time, whether you do private real estate with a fund like the open-ended strategies like Principal, the returns of that component of real estate, the private real estate, and REITs are going to be the same. Over 15 or 20 years, the return rates are going to be the same. What differs is the timing of the returns.
The volatility.
So in 2008, right, it's the and the other aspect of it too is the REITs are 98% correlated to your equity portfolio. And so you get essentially, so if you think of a portfolio that's just stocks and bonds, and you want to add real estate for diversification, but it essentially fully correlates to one of your two asset classes, you're getting no diversification benefit by adding the asset class.
But the diversification benefit, if it's private equity, may be artificial, may be an illusion, that you're just not getting the current pricing on private equity portfolio, and you're relying on private appraisals.
I agree with you in any sort of, let's call it a 2 or 3 year window because of the lag effect and everything. I completely agree with you. But that's what I'm saying. Like, if you're going to be a longer term investor in real estate and you're going to hold it for 10 or 15 or 20 years, I will tend to say that I don't think that really is impacted at that point. Now, your exact timing of your entrance and exit point could affect it. But again, all the work that we've done essentially says the REITs and the private real estate average the same annualized rate of return over 10, 15, 20-year periods. It really comes down to the volatility and the diversification element to it. That's been our primary reason for suggesting private real estate, because it doesn't correlate to your equity. And that's the hard part. You get, well, take 2020 as a perfect example. You know, your equities are down, real estate, it holds up temporarily. Then 21, equities are up. Now your real estate's starting to be a little bit soft, and then it kind of flips back again this year, where real estate's up 20% while equities are off. So you're getting that dampening effect for the overall plan.
Yeah, assuming you accept the accuracy of those valuations.
Yeah.
The principal closed down for withdrawals for a while.
I'm sorry?
The principal closed down for withdrawals a few years ago.
Yeah.
They're
open again now, I think. They just, you went into a queue. There was a queue. And I forget, it was probably 3 quarters, 2 or 3 quarters, or might have been a year.
And that's actually very typical. Most open-ended strategies, real estate strategies, now have an exit queue. And meaning if you've got your $20 million in and you raise your hand, you say, I'd like 5 or 10 or whatever it is out of that fund, they'll say, okay, there's a lot of other investors along with you that want money out, and we'll let you know at the end of the quarter how much, if any, of what you requested you're going to get.
When are you starting the quarterly thing versus the one time a year?
Well, assuming I can get accurate numbers from accounting, or maybe I'll just have to
Wing it?
reverse engineer it. Again, so probably that would mean that we would do a withdrawal in December.
I know where you're going with that.
I mean, this seems like a perfect place to take that withdrawal from.
Yeah.
Is that not something we should go ahead and get in line for if it's
Yeah.
gonna be?
If we're interested in doing it.
I mean, it's obviously been the best performing portfolio. You guys, we're talking here, we're real estate, we all believe, I think it's headed downward versus upward from this point, based on the rate hikes that are already happened.
We'll give them a call and see what the queue is. It may be shorter now, but, you know, I would expect that everyone's kind of thinking the same thing, that their real estate's outperformed, so if they're going to rebalance, they're probably taking it from real estate.
But if they're thinking it versus whether they're doing it. So I'd rather be the first doing it.
I've had plenty that have already entered a queue. I mean, JP Morgan just last month paid out 7% of the requested balances. You know, so obviously at that run rate, it's going to take you years. Now, it won't stay there, but just in that particular quarter, they paid out 7%.
To your point, I like where you're going with that. You make the request, would it make the request for 2 quarters worth? I'm just trying to think how we.
I was sitting here thinking, excuse me, how much you ask for to get this?
Yeah.
If you're only gonna get 7%, ask for all of it.
Yeah, so that'd be about half of what's in there. You know, just ballparking, I would say, you know, we'd be looking at taking 8 million a quarter. It could be a little bit different, but, you know, so 16 million from them.
Make an ask and see where we're, I think that'd be you know the cash flow better, but it just seems to me that
We can
6 months is pretty short.
go ahead and get in that queue. That makes sense.
And we've already locked in the losses on our bond portfolio
Yeah.
with the recent withdrawal, so I don't know when we take any more from there, right?
Yeah, there's not much to
There's not
take.
much left.
Correct,
to take.
there's not much there,
We're
so.
working our way towards 100%, right?
Oh, yeah, we're getting close, right?
If the selling supply demand dynamic is going on across the board, that's going to put some pricing pressure on real estate in the next quarter. Anyway, I mean, just to generate the capital flow. Right.
That's what Brian did, right? Before it dropped, he took half the real estate fund in.
Is COVID.
Well,
Before they closed
it dropped, but then it came back, so, you know, I mean, you know, it just depends on it's all endpoint sensitive, right?
Sure.
So,
Yeah, before there was any queue that was implemented, kind of post-COVID,
Yeah,
we got the redemption completed prior to any lockup.
yeah, and then they closed it for like a year or so.
Right.
There was one fun thing in Atlanta, we got same thing, we got out the day before, they shut it down. So we've been, our quick trigger finger has saved us over the last 15, 20 years a couple times in terms of.
Will that help us now?
Yeah, so anyways. All right, Brendan, anything else you wanna?
That is,
I appreciate there's a lot of work, I mean, the book, I was like, we're going through it the other night, but I appreciate that. I think having these discussions is what we're supposed to be doing.
certainly on the quarterly book, that's what I tend to focus on the flash, because it cuts a lot of that extra stuff out of there. But it's one of those things, if we don't generate the material, that's what'll get, a question will be asked. I'd rather have it as a reference and not use it than not have it at all.
and we'll forward the October flash.
Flash.
When we get it.
Okay, any other, we have no public comment, doesn't look like, anything else, William, we need to be thinking about?
Just real quickly, I'd mentioned that the City Commission's Finance Committee met back in August, I want to say, the end of August, and they had been asking staff to, evaluate and present information related to ESG investing for the general pension plan over the past 9 or 10 months, and we've done so, and staff's recommendation is that it doesn't really achieve anything. It doesn't make sense because you're risking portfolio returns by focusing on ESG. Sometimes ESG can be a self-fulfilling prophecy, but the question is, when does that run out of steam? Because
Well, it runs out of steam when there's no coal.
But I think internally, our opinion is that, we believe in more fundamental valuation of companies and based on their returns, and though you might see a temporary increase in ESG, it doesn't make sense as a long-term strategy. But and the committee was sort of split. I think one commissioner was ready to drop it, another was on the fence, but there was one commissioner who still wanted to pursue it. And so the direction from the committee in August was for staff to go out and look at other cities and pension plans and come back with information on how they have implemented ESG mandates or policies. And so that committee is meeting next week, but because of all of the year-end and new fiscal year reporting and validata and things that we have to do, we haven't had time to do that, to put together a presentation. So we won't be making a presentation to them next week. I think the next meeting will be in January of '23, and so we'll go back to them with a presentation then. I've also discussed it with Brendan, and he's going to be available in case we want him to come in and talk about it. I think there's perception from the commission that staff is either biased or unqualified to give them information related to this. So, in an attempt to make them feel more comfortable, we'll bring in our consultant and let him discuss it with them.
We'll rent his credibility for one.
Yeah.
Well, I think
Did you guys see the insert in the
Yeah, I saw that,
journal?
yeah.
It was good.
The focus of the finance committee in January will be different than it was in August. The
Right.
driver, the commissioner who was the driver
Is it-
behind
he's
that
gone?
will be gone.
Now, having said that he could, bring up the issue next week, so I will be at the meeting. I just won't have a presentation in case he wants to, even without the presentation, he could make a motion to move forward with it regardless, because that's the way the commissioners work.
And our city attorney, I think the last meeting I was at, was very clear that ESG was likely having them, fall short of the fiduciary responsibility, and this particular commissioner couldn't give a rat's ass about that. And so he's a wingnut, and fortunately he's termed out, but yeah, he can still, he doesn't care. He's gonna do whatever makes him feel good. And then the other one that was on the board that was more in we'll see today whether he retains the position or not. So there could be, one's definitely gone, another one, who knows?
And the entire committee could be different because with new commissioners, they all get appointed differently.
Oh, that's true.
That's the other thing I was gonna say, the finance committee composition will be different. come February or March when we make the committee. As a year.
So it'll be interesting. Yeah.
But we'll keep the committee updated.
And is there, on comparing other cities, what they're doing with ESG, is there any way to put a fiscal overlay into which of these cities are actually solvent, which aren't? I'm just kind of curious what it would be.
I'll let Brendan speak to it, because from what he told me, you know, there's not a lot of implementation going on.
They're
There's
really not.
Okay.
There are some that are, you know, maybe considering, like if you're looking for a particular search, they might have one manager that does a little bit more ESG as a part of their process, but the ESG isn't a component of the plan. You know, they're not saying we need 50% or all of our managers to be under this ESG criteria.
Doesn't it help that the state government has outlawed the thing or whatever?
not with this city commission,
No,
does
it's
it?
Hey, does anybody here invest their own money in looking at ESG in terms of the criteria?
The answer to
Kinda
that is
tells you
yes,
something.
whatever they're doing, I do that.
Wasn't Bailey Gifford had 18 employees just monitoring the ESG stuff?
Yeah, it was, I don't know.
Well, there's a lot of demand, and the managers are going to
Yeah.
respond to demand from the clients.
They
The
should
question
turn
is,
those
does
people
it,
over to
does it
invest in
achieve
China
anything,
homes.
and does it hurt your returns?
The
But
European
some people
Union's
don't
had
care
another
about
thing.
that. Some people just want it so they can say they have it.
Well, clearly, that's the case.
Yeah, the European Union is mandating, I mean, they're forcing Bailey Gifford's hand, all those European money managers have to.
They're kind of ours.
Our new
Doesn't that
company
by
is strictly a
definition-
result of this.
Brenda,
Doesn't
is there
that-
any empirical evidence that an ESG portfolio is worse than a regular one? I don't think there is. I don't
Depends
think-
on the time
I was
period you
gonna
look
say, I don't
at.
think the issue is the return. The issue is whether or not it should even be considered as part of the process, because it is a violation of fiduciary responsibility.
Yeah,
I would never get up in front of the city commission and tell them that if they decide to go with an ESG portfolio, they would hurt the return,
Yeah.
because I don't think you can demonstrate that.
You have another issue too, where you'll have two different managers that claim to be ESG, and one will say, Apple is the best in terms of corporate governance, and you have to do this, and they're the hallmark of an ESG type firm. And you'll have the next one that says, I cannot invest in Apple because of their production in China and all this kind of, so you'll have.
Carbon footprint somewhere, yeah.
Right, and so there is no standard with ESG. That's, from our standpoint, that's one of the biggest issues, is there is no established criteria what truly is or is not ESG.
Yeah.
How do you measure it?
and the consultants all vary on how they evaluate individual.
Right.
But can't you demonstrate that the management fees for the ESG funds are clearly higher? I mean, that's easy enough to do.
I think that's more, I think a fee discussion is marginal. I think this issue needs to be addressed, as John pointed out, at the level of the city attorney. This is not an issue of returns or fees. This is an issue of whether or not the commission has the authority to essentially run counterintuitive to the language in the trust. Language in the trust states that you're driven to generate the highest return given the risk profile. Those are the only things they should be considering. Now, there will be some commissioners, like the one that William is referencing, that will state that he is looking at that. And he believes going forward that the ESG funds are going to return better, because that's the way the populace is turning. It shouldn't be a consideration, it shouldn't be part of the argument. William's been telling them that, but it's going to land more in the lap of the attorney.
And our managers already do ESG evaluation to the extent that they think it impacts the valuation of their portfolio and the stocks they're selecting. And that's the way it should be done.
Well, I appreciate the update. Yeah, it's interesting makeup right now in the commission. So, any other elements? If not, I'd be happy to entertain a
Did you
motion
see
to
that, William, this week?
end the meeting.
So moved.
I'm going to have a second. All right, we are adjourned. Thank you, everybody, as always. Always good discussions.